Hey, welcome back. Today's mission in this deep dive is to unpack the current realities of personal finance in Korea.
Right. It is definitely a tightening environment for folks out there right now.
Yeah, exactly. We're going to look at that tightening grip of borrowing costs and, well, how different financial institutions are responding to the pressure. Okay, let's unpack this.
To really understand it, we have to look at how the foundational cost of money is changing.
Right, because securing a mortgage right now, it feels like trying to hit a moving target while running uphill.
That is a very apt way to put it, honestly.
And starting next month, banks are raising additional mortgage rates. If you are looking at a new loan over 200 million won, you could see a zero point 0.1 to zero point 0.2 percentage point increase.
What's fascinating here is the underlying mechanism driving those numbers. As of March 27th, the 5-year bank bond yield actually reached 4.119%.
Wait, let's pause there for our listeners. What exactly does that bank bond yield dictate?
Well, think of it as the wholesale price banks pay for money before they mark it up and sell it to you as a mortgage.
Ah,
Yeah, and because that wholesale cost went up, fixed mortgage rates at the top 5 banks hit a range of 4.410% to 7.010%.
wow, up to 7%.
Right. It is a notable threshold, as it is the first time fixed rates have crossed the 7% mark in 3 years and 5 months.
So the banks are essentially just passing their increased wholesale costs directly on to the consumer.
Exactly. And because traditional borrowing is becoming so expensive, we are seeing a structural migration of capital across the board.
Yeah, and while regular folks face these steep borrowing costs, it's intriguing to see where community level funds are actually flowing.
Definitely. People and institutions are, exploiting gaps in the market.
Right, and here's where it gets really interesting. When we look at alternative capital structures, local cooperatives are stepping into spaces you just wouldn't expect.
Oh, for sure.
Take the Seoul Livestock Cooperative, for instance. They reached a massive 5.275 trillion won in deposits.
Which is pretty wild, as it makes them larger than quite a few established savings banks.
But wait, hold on. A livestock cooperative has over 5 trillion won in deposits. Are farmers suddenly buying up all the luxury apartments in Seoul or something?
Well, not exactly. Despite their working class and agricultural roots, 94.78% of their loans are tied up in real estate collateral.
Almost 95%.
Yeah, while their basic credit loans make up only 1.49%. And furthermore, nearly 48.7% of their loans went to non-members.
So almost half their money is going to people entirely outside the cooperative. Why abandon basic credit for real estate?
It comes down to profit incentives and regulatory arbitrage. Property-backed lending offers a secured return that basic unsecured member credit simply cannot match in a high-rate environment.
I see.
They essentially pivoted away from traditional member-focused finance to chase the stability of real estate.
So while local co-ops act like major real estate lenders, the everyday borrower is feeling the squeeze. With borrowing costs surging, how are regulators and major institutions trying to ease this immediate pressure on households?
If we connect this to the bigger picture, we see two distinct targeted relief efforts. First, the Financial Services Commission is pushing for auto insurance discounts linked to the 5-day driving system.
Right, and just for our international listeners, that 5-day driving system is a voluntary program where drivers agree to leave their cars at home 1 day a week, right?
Correct. The FSC is using that system to combat the impact of high oil prices on daily commuters. It's a very practical policy lever.
Okay, that makes sense. And what about the second effort?
Second, on the institutional side, Shinhan Financial Group is injecting 100 billion won into the Microfinance Foundation.
And what I find really compelling about that data point is how it's structured. Of that total, 20 billion won is specifically aimed at helping faithful repairers build assets, not just clear debt.
Right.
It acts like, giving someone a ladder instead of just throwing them a rope while they tread water. It allows them to actually climb out.
That is a great analogy. Asset building changes the long-term financial trajectory for those borrowers, rather than just providing temporary liquidity.
Yeah, absolutely.
But as we look at all these moving parts, it raises an essential question for you to consider. Major commercial banks, like Shinhan, are stepping in to fund grassroots microfinance, while traditional grassroots agricultural cooperatives pivot to lucrative real estate.
It is quite the role reversal.
It really is. We have to ask, is the fundamental DNA of Korean banking permanently swapping roles?
That's all for today's deep dive. We'll be back with more insights. You've been listening to the Korea Economy Brief, straight from the front page of Seoul Economic Daily. Thanks for tuning in.